March 20, 2026, Indian equity markets closed in positive territory, with the Sensex gaining 326 points and the Nifty up by 112 points. However, both indices finished well below their intraday highs, signaling that selling pressure emerged at elevated levels. The session saw a significant rally, adding nearly 3 lakh crore in market capitalization, but the inability to sustain those highs reflected a lack of conviction among buyers. This pattern suggests that while there was optimism early on, underlying caution and the presence of supply zones above 350 kept the market in check. The day's movement was more of a technical bounce rather than a true trend reversal, as global uncertainties continued to weigh on investor sentiment. Primary catalyst for the market's early strength was a wave of global relief and easing concerns, which fueled strong opening momentum. However, this optimism faded as renewed geopolitical tensions, particularly the Iran-Israel conflict, resurfaced and dampened risk appetite. In the second half of the session, firm crude oil prices, hovering around $109.06 per barrel, triggered a late sell-off. Higher oil prices raise inflation and current account deficit risks for India, directly impacting market valuations. Additionally, Accenture's robust results and upgraded guidance gave a boost to IT sentiment globally, driving flows into Indian IT stocks as investors sought exposure to the global tech recovery. Despite the initial rally, the broader market structure remained cautious, with a prevailing sell-on-rise approach. Resistance was noted at the 23,350-23,600 range, while support held firm at 23,000. This setup indicates a range-bound market with a bearish undertone, as investors remain wary of chasing prices higher. The recovery was largely technical, bouncing back from previous sell-offs rather than signaling a fresh uptrend. Global uncertainties, especially those related to oil prices and geopolitical risks, continued to dominate market sentiment, overshadowing domestic fundamentals. Market breadth was positive, with an advanced decline ratio of about 3:2, indicating broader participation even as index-level weakness persisted. Mid-cap stocks outperformed, rising by 0.67%, which reflected selective risk appetite and stock-specific buying in a volatile environment. However, participation was uneven, as large-cap heavyweights faced selling pressure, capping the upside for the main indices. This divergence highlights that while some segments of the market are attracting buyers, others remain under pressure, contributing to a mixed overall picture. It emerged as the top-performing sector, gaining 2.17%, driven by global cues such as Accenture's strong results. This signaled early signs of sectoral rotation into beat-down defensives. Metals also rallied, supported by commodity strength and expectations of cyclical recovery, with Tata Steel and JSW Steel leading the gains. Pharma and healthcare sectors saw defensive buying, aided by rupee depreciation that improved export realization. In contrast, the banking sector underperformed, with Bank Nifty ending flat to negative after giving up significant intraday gains, indicating distribution at higher levels. Among the top positive contributors were Tech Mahindra, Infosys and Tata Steel, all benefiting from the IT rally and metal strength. On the downside, HDFC Bank fell over 2%, extending its recent sharp correction and acting as a major drag on the index. The broader market saw gainers like IOB, Aditya Birla Fashion and Vodafone Idea, reflecting retail and mid-cap participation. However, MCX declined by about 5% due to institutional bearish positioning, while Petronet LNG also fell sharply, hitting a 52-week low amid Middle East supply disruption risks. Accenture's Q2 results beat expectations, with revenue at $18 billion and bookings at $22.1 billion. This triggered a strong positive read-through for Indian IT companies, signaling demand stability in outsourcing and artificial intelligence. The sector-wide re-rating expectations particularly benefited Infosys, TCS, HCL Tech, and Tech Mahindra. However, commentary from Accenture suggested that the recovery is being driven by cost optimization rather than discretionary spending, implying that any upside may be gradual rather than sharp. Crude oil prices surged near $109-110 per barrel, driven by Middle East conflict and supply fears which directly triggered late-session profit booking. Copper prices showed strength, supporting metal stocks, while zinc remained weak, indicating mixed signals for industrial demand. Energy supply risks, especially due to potential disruptions in Qatar's LNG exports, emerged as a major macro overhang for India, particularly affecting gas-linked sectors and raising concerns about future stability. Indian rupee hit a record low of approximately 93.7 per US dollar, marking one of the sharpest depreciations in recent years and the worst performance among Asian currencies in 2026. This decline was driven by rising oil prices, capital outflows, and heightened geopolitical risk, all of which increase imported inflation and put pressure on RBI policy decisions. While a weaker rupee supported IT and pharma exporters, it negatively impacted oil marketing, aviation, and other import-heavy sectors. The market displayed a classic gap-up to sell-off structure, confirming the presence of supply at higher levels and a lack of follow-through buying. Late-session selling was triggered by a spike in oil prices and escalating geopolitical tensions, reinforcing the dominance of macro factors over price action. The technical structure remains fragile, with 23,000 as a key support and 23,350 as strong resistance, underscoring a range-bound but weak trend for the near term. Several stocks made headlines for their unique moves. Zomato increased its platform fee by about 19%, signaling pricing power and a focus on margin expansion, which is positive for profitability. Tata Power signed a power purchase agreement with Gujarat, enhancing long-term revenue visibility. HDFC Bank continued to face governance issues, leading to significant value erosion. Meanwhile, Brainbees' first cry hit the 20% upper circuit and Happiest Minds surged 11% on private equity interest, reflecting ongoing enthusiasm for digital and IT assets. Today's market move is best described as a relief bounce within a weak overall structure, rather than a true trend reversal. Global macro factors, such as oil prices, geopolitics, and currency movements, are currently exerting a stronger influence than domestic fundamentals. The market is entering a stock-specific phase, where IT, pharma, and select power or capital goods companies may outperform, while banks and energy-linked plays are likely to remain under pressure. Key levels to watch are 23,350, 23,600 on the upside, and 23,000, 22,900 as critical support. Market is currently moving within a well-defined falling channel on lower timeframes, consistently forming lower highs and lower lows. This confirms the presence of a downtrend and a continuation bias unless a decisive breakout from the channel occurs. The structure remains fragile, with sellers dominating and buyers struggling to sustain any upward momentum. This technical setup reinforces the overall bearish tone, making it crucial for traders to remain cautious and watch for any signs of a reversal. Strong supply zone has been identified between 23,600 and 23,900, where multiple rejections have occurred. This area aligns with a previous breakdown zone and serves as an immediate ceiling for any market bounce. Unless the market can decisively break above this range, it is likely to face continued selling pressure, making it a critical level for both traders and investors to monitor closely. Immediate support zone lies between 23,000 and 22,900, a region that has held up multiple times in recent sessions. If the market breaks below this critical demand area, it could trigger a sharp downside move toward 22,700, 22,500. This makes the support zone a key battleground for bulls and bears, with significant implications for short-term market direction. Price is currently trading below all major moving averages, including the 20, 50, 100, and even the 200-day moving averages. This alignment across multiple timeframes indicates a strong bearish trend, with resistance levels stacking up above the current price. Such a setup suggests that any upward moves are likely to face stiff resistance, reinforcing the need for caution among market participants. Recent market bounces, such as the move from around 22,800 to 23,800, have failed to sustain and have formed lower highs. This pattern confirms that buyers are unable to maintain momentum, which is typical of bear market rallies. The inability to break above previous highs signals persistent weakness and a lack of strong buying interest. The next session, resistance levels are set at 23,600, 23,900, and 24,200, while support is found at 23,000, 22,800, and 22,500. The market remains in a sell-on-rise mode unless it can decisively reclaim 23,900. These levels are crucial for traders to monitor, as they will likely dictate the next major move in the market. Options data reveals a strong buildup of call open interest, OI above the spot price, particularly between 23,500 and 24,500 strikes. This heavy call writing indicates a strong resistance zone and bearish positioning by institutional players. Such a setup suggests that the market is likely to face significant hurdles in moving higher unless there's a sharp shift in sentiment. Highest concentration of put open interest is clustered around the 23,000 strike, marking it as a critical support level. If the market breaks below this point, it could lead to rapid unwinding and accelerate the downside. This makes 23,000 a pivotal level for both option writers and market participants. The put-call ratio, PCR, has dropped sharply from higher levels toward 1 or below, indicating a shift from neutral to bearish sentiment. This trend reflects more aggressive call writing and a lack of bullish conviction, further reinforcing the market's downside bias. Around the 23,100, 23,300 zone, options data shows a combination of call addition and put reduction. This pattern confirms a short buildup and a lack of bullish confidence in the market. Such signals are important for traders as they often precede further downside moves. The overall options structure suggests that the upside is heavily capped near 23,500, 23,800, while the downside remains open if the 23,000 support breaks. This means that if the market fails to hold above 23,000, a faster and sharper fall is possible, making risk management crucial for all participants. Bringing together price action and options data, the overall trend is confirmed as bearish, with a clear sell-on-rise structure. Key trigger levels to watch are above 23,900 for a potential short covering rally and below 23,000 for a fresh breakdown. These levels will likely determine the market's next major direction, so staying alert to these triggers is essential. Trinidad LNG fell about 5%, hitting a 52-week low and becoming one of the weakest stocks of the day. The primary trigger was geopolitical escalation in the Middle East, specifically a reported strike on Qatar's Ras Laffan LNG hub, which is vital for global LNG supply. With 47% of India's LNG imports dependent on Qatar, Petronet's business is highly exposed to such risks. The company has already issued force majeure notices, signaling real operational impact and raising concerns about near-term earnings. Risk of supply disruption is severe for Petronet LNG, as the Strait of Hormuz has become unsafe, impacting logistics. With long-term contracts tied to Qatar, any interruption in supply can have immediate and significant consequences. The company's recent force majeure notices highlight the seriousness of the situation, and with acts of war not covered by insurance, valuation compression is likely to persist. Key risk for Petronet LNG is an earnings vacuum in the near term, as ongoing geopolitical tensions and supply disruptions threaten revenue streams. With insurance not covering acts of war, the company faces heightened uncertainty and the possibility of further valuation declines. Investors should be cautious, as the outlook remains clouded by external risks. HDFC Bank came under heavy pressure following the sudden resignation of its chairman Atanu Chakraborty, which led to a massive 1 lakh crore erosion in market capitalization in a single day. The resignation, citing ethical concerns without detailed explanation, created uncertainty and damaged investor confidence. This event has pushed the stock into bear market territory, down over 21% in 2026. Despite the governance crisis, both the RBI and Finance Ministry have reassured investors that HDFC Bank's fundamentals remain strong. The bank's credit rating continues at AAA stable, indicating no structural business risk. While short-term sentiment is negative, the long-term outlook could improve if clarity emerges and confidence is restored. For now, volatility is expected to persist. Accenture reported robust Q2 FY26 results, with revenue of $18 billion and bookings of $22.1 billion, beating market expectations. The company also raised its full-year guidance and increased its free cash flow outlook, signaling improving sector visibility. AI demand is a major growth driver, with record AI bookings and a workforce of over 85,000 in this area, reinforcing the next growth cycle for IT companies. Accenture's strong performance triggered a more than 2% rally in the Nifty IT index, benefiting major Indian IT firms like Infosys, TCS, HCL Tech, and Tech Mahindra. The results signaled resilience in global IT spending and reinforced the global-to-local linkage for Indian tech companies. However, growth is currently driven by cost optimization deals rather than discretionary spending, suggesting that the recovery may be gradual. CX stock experienced a sharp downturn, falling about 5% in a single session and over 10% in 3 days. The main trigger was the entry of NSE into commodity derivatives, particularly gold futures with delivery, which directly threatens MCX's monopoly business model. This competitive threat has led to a reversal in sentiment and a bearish trend for the stock. NSE's plan to expand into crude oil and natural gas derivatives poses further risks for MCX, as these are its largest revenue contributors. Additionally, NSE offers margin fungibility across segments, while MCX cannot, putting it at a structural disadvantage in terms of liquidity and trader preference. This shift in the competitive landscape is likely to keep pressure on MCX's stock. Open interest OI data for MCX shows a 10% rise in OI alongside a price fall, indicating strong short buildup. This pattern suggests that institutions are positioning for further downside, and the stock could remain under pressure as the competitive threat from NSE intensifies. Zomato increased its platform fee by nearly 19%, from Rupee 12.5 to Rupee 14.9, demonstrating its pricing power and a focus on margin expansion. This move is seen as positive for the company's profitability and signals confidence in its ability to pass on costs to consumers without significant pushback. Tata Power signed a power purchase agreement (PPA) with the state of Gujarat, which supports long-term revenue visibility and strengthens its order book. This development is positive for the company's growth prospects and provides greater stability in an otherwise volatile market environment. Rainbees, the parent company of FirstCry, hit the 20% upper circuit, indicating a sharp speculative recovery in a previously beaten-down stock. Such moves often reflect renewed interest from traders and investors looking for turnaround opportunities, but they also come with heightened risk and volatility. Happiest Minds surged by about 11% after news of private equity stake interest emerged. This continued interest in digital and IT assets highlights the sector's appeal, even in a volatile market. Investors are keen on companies with strong digital capabilities and growth potential. Market is witnessing early signs of sector rotation, with investors moving into beaten-down defensives like IT and pharma. This rotation is driven by global cues and the search for stability amid ongoing macro uncertainties. Sectors linked to exports such as IT and pharma are benefiting from rupee weakness, while banks and energy-linked sectors remain under pressure. Global macro factors such as oil prices, geopolitical tensions, and currency movements are currently the dominant drivers of market sentiment. Domestic fundamentals are taking a backseat as investors react to external shocks and uncertainties. This environment calls for a cautious approach, with a focus on risk management and selective stock picking. Traders and investors should keep a close eye on key technical levels. Resistance at 23,350, 23,600, and support at 23,000, 22,900. A decisive move above resistance could trigger a short covering rally, while a break below support may lead to accelerated downside. These levels are likely to shape market action in the coming sessions. In a volatile and uncertain market, risk management becomes paramount. Traders should use stop losses, monitor position sizes, and stay alert to sudden changes in macro conditions. Being nimble and disciplined can help navigate the challenges and capitalize on emerging opportunities without exposing portfolios to undue risk. Sum up, the Indian market's latest move was a relief bounce within a weak structure, shaped by global macro factors and technical resistance. The outlook remains cautious, with a focus on key support and resistance levels. Sector rotation into defensives and stock-specific action will likely define the near-term landscape. Staying informed, managing risk, and focusing on quality stocks are the best strategies in this environment.